Hey, welcome back here. So a friend of mine recently asked me the question to know if he will have to pay any tax on the death benefit that he will receive. Disclaimer here, I'm not an attorney, I'm not a lawyer. Um, I don't have the qualification to give you legal advice. But what I wanted to do here is just review public information. And if you need more insight, I highly advise that you talk to a qualified person. Find an attorney that can give you the exact advice that matches your situation. So let's start here with the IRS website. So it states that most income is taxable unless it's specifically exempted by law. Okay, you can read all the page and all the associated pages. Now let's go and read about this is section 101 of the Internal Revenue Code. So if we go here in section 101, and section A, proceeds of life insurance contract payable by reason of death. And it states, except as otherwise provided in paragraph 2, 3, subsection D, F, and subsection J, gross income does not include amount received, whether in a single sum or otherwise, under a life insurance contract if such amounts are paid by reason of death of the insured. So there are some exceptions to this rule. I'm not going to go there. But the point here is that in general, if you receive a death benefit, it's not considered to be an income. As a result, you as the beneficiary will not have to pay taxes. But that's not where the story ends. Because if there is a beneficiary, there is an insured that passed away. Now, if we look at this side, we have what is called estate taxes. The estate tax is a tax on your right to transfer property at your death. It consists of an accounting of everything you own or have certain interest in at the date of your death. So you can go deeper into all the reading. But the point here is that when you pass away, if you are the person that has a life insurance contract, there is an account of all the things that you own. And all of those things have a certain value. And that becomes your gross estate. If you read through all these paragraphs, there might be some exemptions. There might be a few things that allow to decrease the size of your gross estate. So let's read this last part. A filing is required if the gross estate of the decedent increased by the decedent adjustable taxable gift and specific gift tax exemption is valued more than the filing threshold for the year of the decedent death as shown in the table below. So if you scroll down, you will see that back in 2011, it was $5 million. And now in 2025, it's almost $14 million. The point here is, if someone has a life insurance contract, is the insured, and he passes away, he has an estate. And that estate accounts for all the things that that person owns. When that person passes away, before you transfer that wealth to someone else, there has to be an account of the size of that estate. At the end of the day, if the net estate is bigger than this value, then estate taxes will be expected. When you have a life insurance contract, if you want to avoid paying taxes on the death benefit when you pass away, and before that money is transferred to your beneficiary, you have to take into account the size of your estate and make necessary adjustment before you pass away. Now, for more detail, I highly advise that you talk to an attorney. With this, I would like to stop this recording here. If you like this content, please make sure to like and subscribe. Between now and my next episode, stay safe.